Hey all, welcome to Share Trek. This is Raj here. Friends, if you recollect, in the morning when I had done the pre-market video, I had said that there are two articles on CNBC that caught my attention, which are exactly in the area of the three videos that I released earlier, talking about the new Trump administration's tariff policy, its tax cut policy, and its spending policy, and how it's going to impact various sectors of our economy and our watch list. Now, it's a continuation of that as promised. I've gone through both the articles, analyzed it, and put it against my own thoughts, and I've come up with a repositioning. And what I call it is what's ahead for the economy in 2025, tariffs. Now, new element is the port strikes and also tax policy. So let us look at the overall impact of all these things. And as always, friends, at the end, please comment and let me know what you think. Your ideas are very important to me. We are a retail investor channel, and your inputs can definitely help shape my thoughts as well and can figure in all the future videos. With that said, let's get started. Welcome back, friends. There are these two articles that I'm seeing out here on CNBC, which I was speaking about. A double whammy is coming for US trade and global supply chain in early 2025. I had just briefly mentioned about this in my previous video, but now I have more information from this article. And then there's another one here which says, here's why Trump's tax plans could be complicated in 2025. So they have gamed out a few scenarios. And I have taken both of these together and tried to identify which sectors may benefit and which may not benefit, whether Trump carries out his plans or whether he decides not to do 100% of his plans. So those are the scenarios that I have gamed out. And what I would like to say is that we are talking about the economic storm brewing for 2025. There are three big developments that could seriously impact trade, businesses, and consumers in the US. First, we are looking at the possibility of new tariffs under President-elect Donald Trump. Second, we got potential strikes looming at key US ports. And I'm going to talk about specific dates out here so that we can calibrate our expectations. And finally, there's a lot of uncertainty around tax policy, with some major tax cuts set to expire and new tax proposals being debated. Again, I'm going to talk about the dates out here so that we can be much more specific in our understanding. And these issues are all intertwined with each other, and the ripple effects could reshape the economy in significant ways. So I'm going to attempt to break this down. Let us look at the tariff situation. The big expectation is that Trump will reintroduce tariffs possibly as early as late February or March 2025. And these tariffs are likely to target imported goods, making them more expensive and potentially boosting demand for US-made products. Sounds good for domestic manufacturers, right? But here's the catch. Businesses that rely heavily on imports, like retailers, electronics companies, and the automotive sectors, could see costs shoot up, which might get passed on to consumers. And companies are already trying to get ahead of this by front-loading inventory. That means rushing to import goods before the tariffs kick in. And you can do only so much. You can only stockpile so much of goods. And after that, you're going to run out of the goods that you have stocked and you're going to import. And that's when the tariffs will strike. So at the most, what this will do is delay the impact of the tariff. At the same time, with a lot of inventory in hand, there could be some sales action taking place. And with warehouses filling up as businesses prepare for what's ahead, but this isn't a foolproof strategy. If tariffs are delayed or adjusted, it could lead to overstocking and inefficiencies down the line. Some panic sales may come up to liquidate those advance inventory that has been bought in. Now, the other spanner in the works, which I had not considered before, is the port strikes. Adding fuel to fire, if tariffs weren't enough, there's another headache for global supply chain, a potential port strike at East and Gulf Coast ports in the US. The current negotiation deadline is January 15, and if the two sides cannot agree, we could see another round of strikes like the one in October, which caused weeks of shipping delays. And this timing couldn't be worse. Strikes could overlap with Lunar New Year, a time when Asian manufacturing shuts down for weeks. Businesses that don't stockpile enough inventory could find themselves in a tough spot, struggling to meet demand. Also, not only am I looking at finished goods which are being imported, but also spare parts, like if you're in the automobile industry or appliance industry and you're looking for spare parts, and they are not available, and that could also cause problems. And if production is not going to be done, then you will have lockouts and things like that happening. And for companies with inventories already tied up at the ports, the cost of delaying warehousing and expedited shipping will be another blow. But let us say the companies decided that, well, let us hedge this risk by importing everything in advance, and then the strike doesn't happen and Trump doesn't put tariffs. That could take the companies in a whole different direction. So the risks are very high for many of these companies which are depending on imports. Now let's add tax policy uncertainty to the mix. On the tax fronts, things are equally messy. Some of the tax breaks from Trump's 2017 tax cuts and Job Act are set to expire in 2025. This includes lower income tax rates, a more generous child tax credit, and other perks that benefited businesses and individuals. If Congress doesn't act, tax rates will go up, which could hit middle income households hard and dampen consumer spending. Trump is also proposing new tax ideas like eliminating taxes on tips and social security benefits, along with universal tariffs. But when I look at tax on tips, I think the people who are earning in tips most likely are not paying any tax right now. So that's more of an optical illusion. But social security benefits not being taxed is a positive. At the same time, I don't know if social security will survive the way it is right now if they do a 2 trillion tax cut. And then universal tariffs are going to mean that probably China will be punished with heavier tariffs, but rest of the world is also going to face tariff when it comes to imports into US. So there is going to be some tariff all over the place, but heavy Chinese imports are going to be tariffed much higher. But here's the kicker. Congress has packed agenda, and policy experts says that it could take months, maybe even until the end of 2025 to finalize these tax changes. That means businesses and consumers will face months of uncertainty. And in this scenario, I have tried my best to game who wins and who loses if tariffs are imposed, and who wins and who loses if tariffs are not imposed. So I've kept it as simple as possible for my own thinking process, keeping some variables constant. So if tariffs go into effect, domestic manufacturers like those in steel, agriculture, and textiles are likely to benefit. They will face less competition from cheaper imports. Logistic companies and warehousing providers could also gain as businesses scramble to manage inventory and shipping bottlenecks. Expect shipping companies to increase freight charges, expect warehousing companies to increase their charges, and transporting companies will also benefit. But the losers are import-heavy sectors like apparel, electronics, and furniture. These industries will face rising costs, which can either shrink profit margins or lead to higher prices for consumers. Lower income household could feel the pinch the most, especially if tariffs coincide with higher taxes from expiring tax breaks. However, I think we still have to consider the other alternative. What happens if tariffs are delayed or don't happen? So on the flip side, if tariffs are delayed or scrapped, it's good news for sectors dependent on imports. Retailers, consumer electronics, companies and automotive manufacturers would breathe a sigh of relief. Lower costs means steadier prices for consumers and less pressure on profit margins. But this also means domestic producers will lose out. They won't get the protection from cheaper foreign competition. And without tariff revenue, funding government programs would become even harder, especially with the deficit concerns looming over tax reform debates. And now let us zoom out and look at the timelines. When will it all happen? Here is how I think it might play out. December 2024 to January 2025, businesses will accelerate front loading to prepare for tariffs and potential port strikes. January 15, 2025, the port strike deadline arrives. If negotiations fail, we could see significant shipping delays. February to March 2025 is when the tariffs may take effect, shaping the supply chain and driving costs higher for many businesses. Mid-2025, tax uncertainty looms as Congress debates whether to extend or replace existing tax cuts. End of 2025, by October or December, we'll likely have clarity on tax policies, but it might take until then for businesses and households to fully adjust to the new economic realities. So what does this mean, all of this mean to various entities, including yourself as investors. Let us start with business. For businesses, now is the time to assess supply chain vulnerabilities and prepare for disruptions. Diversifying suppliers, stockpiling strategically, and managing logistics cost could be critical. For investors, domestic manufacturing and logistics sector could offer near-term opportunities, which means the short-term opportunities when people are stockpiling inventory, and while import-reliant industries may face headwinds. And for consumers, brace for higher prices on imported goods if tariffs are imposed, and watch closely for tax policy changes that could affect your wallet. 2025 is shaping up to be a year of economic turbulence. Staying informed and proactive will be key to navigating these challenges. But as an experienced retail investor, I have been investing for quite a while. I think being proactive is going to be fraught with risks, because we may think that the tariff may be imposed, and it may happen that the tariffs are not imposed. So we could end up with a lot of egg on our face. So I would say that be very careful in investing. It's worthwhile sacrificing a little bit of profits in order to be reactive rather than proactive and catch a little bit of margin here and there. I'm speaking from my perspective as a low-risk retired investor, retired retail investor. But if you're a young person, then you could potentially afford to take some risk in this aspect, and you can think differently. But my pitch is more towards retirees and low-risk retail investors who do not have time to keep on following all the small changes that are happening here and there, keeping up with all the news and the competition events happening in the corporate sector in order to keep on buying and selling. If you're not a high-frequency buyer and seller, if you're a couch potato investor, then I would say that it's better to react rather than be proactive. So those are my 2 cents, and this is what I think is going to unfold based on those 2 articles and all my thoughts from earlier, which I summarized in 3 videos. So I'd like to hear from you guys what you think. Please put it in the comment section, and we'll take it from there. Thanks and have a great day. Thanks for watching. Bye for now.